So this question is called Ambush, and it's focusing on financial instruments, but like many Graham Holt questions, it does contain other bits and pieces as well. The good thing about the question is that it's already been broken down into smaller elements for us, and I think that's always of benefit. It gives us a rough idea of what we can expect to deal with. So the first part of the question, it says outline the requirements of IAS 39 as regards the impairment of financial assets. So we're looking for impairment. Now it's talking about the impairment of financial assets. Well, I think the first thing that we have to do is to tell them that there's more than one type of financial asset and deal with the impairment of each type in due course. Per IFRS 9, financial assets are divided between, first of all, those that are measured at fair value through profit and loss. And these are equities and some bonds. Here, any impairment is automatically reflected in the financial asset at the SFP date. Because you're using fair value, so if the value has gone down, i.e. the value has impaired, then it will automatically flow through. The impairment will also appear in the statement of profit or loss, or in OCI if an election has been made. Now, what's the other type of financial asset? Well, we've got those which are measured at fair value through profit and loss, and we've got those that are measured using the amortized cost model. And what we do here is we compare the carrying amount this is the figure per the SFP to the recoverable amount which is the expected cash flows at present value generated by the asset. Any difference is taken to the statement of profit and loss. We discount the cash flows by the rate when the financial asset was acquired. If the payment is due in the short term, e.g. trade receivables, no discount is used. So at the back of my mind, I've seen I've got 6 marks available for this part of the question, and I'm looking to broadly get 5 or 6 points. Each of those points is independent of each other. So I saw the question, outline the requirements, and I then take the approach which I refer to as the eating an elephant approach. How do we eat an elephant? In bite-sized chunks. You take a big issue and you break it down into smaller ones. So impairment, well, what have we got? We've got fair value through profit and loss. We've also got fair value through OCI. We've also got amortized costs. So it's no longer a 6-mark question, it's 3 questions. And we pick those off one by one.
If it was a regular asset.
Part A2 is the loan to Bromwich. So it says the directors of Ambush have heard that Bromwich is in financial difficulties and undergoing a financial reorganisation. The loan would be measured using the amortized cost method because, first of all, contractual cash flows exist. And secondly, Ambush intends to collect the cash flows. We've received the interest to date. Interest is payable by Bromwich at the end of each year, and it's repayable in 2 years' time. But we now believe that we're only going to receive 100,000 and we're not going to receive interest. So the present value of the expected cash flows from Bromwich are 100,000 in 2 years' time, and we're going to discount those by the effective interest rate. So that gives us a figure of 85,734, and therefore we debit the statement of profit and loss. The carrying amount is 200,000. The recoverable amount is 85,734. So we debit the statement of profit and loss 114,266, and we credit our financial asset 114,266. So you don't have to write a huge amount, and what you can find in the question, in the section B questions, especially question 2 and 3, is that if you're happy with the topic, you can do them in less than the 45 minutes which is allocated, so you can give it a little bit more thought. Part B, it says the impairment of trade receivables has been calculated using a formulaic approach which is based on a specific percentage. The general provision approach has been used by the company at the year end. So we then got an analysis of receivables. So let's deal with this bit by bit. Part B. A general provision is inappropriate per IFRS 9 because it does not accurately estimate future cash flows. Ambush should instead assess the credit risk of different types of receivable and calculate the expected cash flows. So if we take a look at these receivables, we've got one of the credit customers, Trey, has come to an arrangement whereby they're going to pay us in a year. So Trey should be separated from other receivables. Because it has a different level of risk. So how much does Trey owe us? It owes us 4 million. It's going to pay us 4.1, but it does say in the question we should use a discount rate of 5%. the recoverable amount for Trey is 4.1 million divided by 5%. So we're going to receive extra money, but by the time we discount it, it equals 3.90 million. The total amount due was 11 million. We've got one called Milk, and it says Milk has a similar credit risk to the other receivables. So Milk and the other receivables should be treated as a single group. Because they've got the same credit risk. The cash flows from this group are 6.6 million, 2 from Milk and 4.6 from the others. Therefore, receivables should be restated to 3.9 plus 6.6 which works out as 10.5 million, an impairment of 0.5 million arises, so that is debit statement of profit and loss 0.5 million, credit receivables 0.5 million. Again, I'm looking at it, 8 marks. Yeah, I've been through, I've got 1, 2, 3, 4, 5, 6. I've got around about 8 points. There'd be perhaps 3 marks for the calculations, or 4 marks for the calculations, and 4 marks for the discussion. So we've done 18 marks worth in 18 minutes. Next, we've got the buildings. We're using the valuation model. We've got cost and details. The initial impairment stroke downward value at the 30th of November X4 should be charged against profits. So let's work out what happens here. We've got our cost and our value model. So we acquired the asset on the 1st of December X3 and go through everything on a time basis. I keep stressing the importance of dates in a question. So we'll have depreciation to the 30th of November X4. How much is that? It's 10 million. The asset has a 20-year life. So at the 30th of November X4, it has a value prior to being revalued of 9.5 million, so that's its carrying amount, and we're told that it was revalued downwards to 8 million. So what would have happened at that date? We would have gone debit statement of profit and loss 1.5 million, credit PPE 1.5 million. We then charge depreciation to the 30th of December X5 on the revalued amount. So we charge depreciation on the revalued amount over the remaining life of 19 years. So that's going to be 8 million times 1/19. Which is 421,000. But when you're using the revaluation model, you should always also keep a record of how the asset would have been treated had we used the historic cost approach. So we would have charged depreciation of 500,000 So at the 30th of November X5, the asset has depreciation charged on the revalued amount over the remaining life. And this takes us down to our figure of 7579. It then says that the 30th of November X5, the value of the buildings had risen to 11 million. When the asset is revalued upwards, the revaluation gain is taken first of all to the statement of profit and loss, to reverse the previous impairment. Having adjusted for the difference in goodwill, for the difference in depreciation. And the way to calculate this figure is I'm simply going to compare the carrying amount of 7579 to the carrying amount that would have arisen had we not revalued. The excess is taken to the revaluation surplus. Via OCI. So what are we doing? We're revaluing an asset, so I'm going to go debit PPE 11 million less 7.579. So we're going to debit PPE 3.421 million. I'm going to credit the statement of profit and loss the difference between the carrying amount that would have existed of 9 million and the carrying amount that does exist, so that is 1.421 million. And I'm going to credit the revaluation surplus with 2 million. And if you think about it, what does that 2 million represent? It's the difference between the 11 million and the 9 million that would have existed had we not operated the revaluation model.